All right, friends, very happy morning, all of you. Yes. So sometimes when you give the laptop to your office fellows, I don't know what they do. They change everything. History also, I'm not able to see anything. Anyway, okay, guys. So we had discussed PGBP, the basics, charging section, section 28. What do you mean by business? What is profession? What is vocation? All that we saw. And especially we understood the charge in the sense section 28 covers specifically so many things. Let it be value of the benefit of perquisite, let it be anything received in cash or cash convertible, anything in kind, any asset under section 35 AD which is being discarded already fully, it was claimed before, be it a club, trade, profession, etc., carrying it on, but then we saw that it should be for what purpose? It should be for a common purpose, no problem. Specific services provided to members will be taxable. Compensation received, the modification of a contract or whether it is termination of a contract. It can also be compensation for the loss of office for a managing director. So, managing director, etc., will get compensation for loss of office. For that, also, it will be taken into account. Then, I told you two things. One is not carrying on any activity, that is non compete. The second one is what? Not sharing any know how, patent, copyright, trademark, etc. Not sharing. That is one more thing. And Keyman insurance policy, we drew that chart to understand. And then any sort of incentive or duty drawback in form of subsidy, tax assistance, export business, all that will be taken into account. Then in the hands of the partner of the firm, then the receipts. TDS also will come, but the receipts, etc. There's an amendment in 2024 up to 6 lakh is 90%, the 3 lakh or 90%, and on the balance it is 60%. And regarding this, of course, there's a taxation of home separate thing that we can see later. Then conversion of inventory, that is capital asset into, sorry, inventory into capital asset. To convert that, then the FMB will be treated as the, what do you say, PGBP. But ultimately, profit will be the 6 crore in my example minus 3 crore. That's the profit, but okay, but the PGBP is taken into account the full thing. Any discontinued business also, whenever you pay, that will be taxable by that time. But even if it discontinued, no problem. Whenever you get the payment, you'll have to pay, no issues. Subsidy. Subsidy will be, what do you say? Any sort of return that you get. For subsidy, we will see that later anyway. But any sort of duty drawback, cash incentive, any return from the government, it will be chargeable to tax, right? And then we saw another amendment, income of from letting out residential house. People were using it as business. Now they said anything will be treated as income from house property. So the taxability will be more on that. Did you guys understand, guys? All of you, yes or no? All of you understood? Any doubt? Thumbs up. Okay. This point, any person for in the connection with the vesting in the government or any corporation owned or controlled by the government under any law for the time being in force, the management of any property or business. So what it means is, you remember some of the banks got nationalized, right? Some of the banks got nationalized. Your syndicate bank got merged with another bank. So in that case, you were actually a private bank or you were a public sector bank, but it got converted into one more public sector bank, right? So when the government takes over, Satyam Computers was a public company. Because there was a fraud, it got converted to a public sector undertaking. In the sense, government took over that company, ensured everything went on well, and then later it was, sold to different company. It became Mahindra Satyam. So what I'm trying to tell is, when that happens, when one public sector undertaking is converted to one more public sector undertaking, then it no longer syndicate bank is no longer syndicate bank, right? Reorganization of banks happen. By that logic, whenever anything merges like that, then you say vesting of the government. In that logic, they may remove some directors, they may keep some directors. By that time, when they are removing certain directors, you will get compensation. Is that compensation also taxable? Yes. It's similar to compensation for loss of office here in other things, A, B, C, D. Same way. That's why on connection with the vesting in the government. Vesting means transfer of that company to that government. Did you understand? Sakti? Clear? Okay. Others have no doubt, I feel. Uh, so it's given in a step-by-step format. Income tax is very easy, guys. Very, very easy. It is simply people make it very difficult. Very easy. Don't worry. Speculative business will do later. Nothing much. Speculative business will be linked to some other section later. Speculative business it means what, guys? It is a separate and distinct business. Basically, it talks about your options, futures, etc. So that obviously will be part of everything. What happens if there's a loss in speculative business? What happens if there's a profit in speculative business and loss? How will it be set off? All that in set off and carry forward, we will see. So some things we can see that later because that will be linked later. We will see that later. No problem. I mean, yeah, now the sequence will go 29, 30, 31, 32, like that. And of course, we can jump to your general stuff 36, 37, and all those things and come back to other sections. There are a couple of other interesting sections also. Easy. Easiest chapter is PGBP. Very easy. Capital gain easy. Everything easy. Simply, chumma, oh, very difficult. Tax is very difficult. Nothing is difficult. Okay, yes. Let's go one by one. And we're doing in depth only. We're seeing everything in depth. We're explaining everything. Okay. So this is not some surface level study. We're doing very much in depth. So let's go. So I will take you through the basics of inter and then go to CFNL level because both are there for you. And during your inter, how you studied, God only knows. We don't know. It's okay. But now we will do it in a correct way. Yeah. And again, I'll try to give you this stuff as I told you. Let me try to extract this and let's see how to give that. So these are things are some of the things which need not be written down. It's okay. That's why you have the material. You can study that more than sufficient. Is the textbook comfortable for you guys, all of you? Is the tax workbook comfortable? Is it understandable, simple language? Yes or no, guys? I've tried to keep it as simple as possible. It's not all hodgepodge. It's not all covered in so many confusing things. Kept it as simple as possible. Is it comfortable for all of you? What about you, Shakti? Okay, cool. Other two, other three people. Okay, done. Other two are also okay. Other people are also okay. Done. Super. Now, guys, computation of PGBP, section 29, and the entire section of this PGBP is from 30 to 43B. It continues, but the thing is, the main charging section is 28, but 29 is how will you compute? Computation is given in this section. So, for example, if my company got incorporated in April 2023, But I started the work on my company in Jan 2023. And between Jan 2023 and April 2023, there's an expense of 40 lakh. This was all my pre-incorporation. Expense of 40 lakh. Of course, I started the company in the sense I had the idea. I would have done some expenses. I would have also registered my company. That also would be expenses. I would have dealt with certain people to start the company. I would have opened an office in anticipation that my company will begin. All that expenses will be there. Now, how much is that? In my approximately 40 lakh. Then I got some pre-orders, a very specified product. I got some pre-orders. Then income also I made, guys. I did a couple of deals. I made an income of 1 CR, right? And after this April 2023, when my company is incorporated, I made an income of 5 crore. 5 crore, absolutely no doubt about it. 5 crore will go to profit and gains of business of profession, PGBP. 5 CR will go to what? PGBP, no doubt about it, because this happened after incorporation. 5 crore happened after incorporation. But what happens to is 1 crore minus 40 lakhs? 1 crore minus 40 lakhs, 60 lakhs. Will you get, what do you say? Will you pay tax? How will you pay tax in the hands of the company when the company only is not there? How will you pay tax in the hands of the company and the company only is not there? So does it mean 60 lakhs, 1 crore minus 40? Does it mean 60 lakhs is not taxable? Or it is taxable in some other hands? That's the question. There can never be a scenario when Nirmala madam will not take tax. Tax will be levied, but it cannot be levied as a company because company comes into existence only from April 2023. How will you levy? And what is the legal validity of pre-incorporation contracts? What is the legal validity of pre-incorporation contracts? What is the legal validity of pre-incorporation contracts? So, this pre-incorporation contract from January to April, this is void ab initio in Indian Contract Act. It cannot be done in the name of the company and you cannot do that. As per Indian Contract Act, it is void ab initio. But there is another law called Specific Relief Act, 1963. This is just for your knowledge. No need to write down all this thing, just for your knowledge. In Specific Relief Act under 1963, it is valid only if all the three conditions are satisfied. One, it should be bona fide, means in good faith. Second, the expense should be needed for the purpose of incorporation. For example, if I enter into a contract with a landlord for giving rent to an office, that office is very much needed for incorporation because in the incorporation certificate, I should know where is my office situated, in which state. Right, so registered office is mandatory for incorporation anyway. So if I enter into a deal with the landlord, is it valid? Yes. And third, after incorporation, shareholder should approve this particular transaction. So three things: to be bona fide, it should be needed for the purpose of incorporation, and after incorporation, shareholder should approve. By that logic, any pre-incorporation contract will be valid, not as per Indian Contract Act. That's why to ensure that these things will become valid, there is another law called Specific Relief Act. Again, it is 1963 law. Sir, you forget about in Contract Act, sir, you forget about Specific Relief Act. In Income Tax Act, what is the scene, sir? You tell me. I don't care about other laws. In Income Tax Act, is 1 crore minus 40 lakhs. Correct? some of the expenses are allowed under preliminary expenses route under 35D. Not all, some. 35D preliminary expenses can be all added and it will be allowed over the next 5 years. 1/5, 1/5, 1/5 like that is allowed under 35D. You may know it in CA Inter. If you don't know it also, it's okay. We'll do it in CA final again. Don't worry. CA CMA final, we'll do it again. You may have forgotten it in CA CMA, CS Inter. Right? Sum of the expenses is 1 crore minus 40 lakhs. That is the 35 D expenses only. This 40 lakhs expense. This 40 lakhs expense, preliminary expenses. Preliminary expenses, some of them are allowed in Income Tax Act under 35D. 1/5 is allowed. Means for the next 5 years after incorporation, it will be allowed equally. This is which one? 35D. 1 CR minus 40. But only 40 is allowed. What about the remaining 1 crore? Is it taxable? 40 lakhs, okay, you've taken it. What about 1 crore? On the other hand, what if this 40 lakhs is not covered in 35D? That is also possible. I told you 35D is only certain expenses, not all. In case this 40 lakh is not covered in the 35D, then what about my income minus expenditure? That is taxable income of 60 lakhs. How will it be taxed? Will it be taxed in the name of the company? That is not at all possible because company is not formed only. So guys, it will be taxable not in the hands of the company, but in the hands of the promoters as a AOP. The income tax department will still tax, but not in the hands of the company, but in the hands of the promoters as what? Association of persons. It will be taxable in the hands of the company, not in the hands of the company, but in the hands of the promoter as what? AOP. We discussed a concept called AOP in the basics. And I told you AOP is not for a charitable purpose or something. AOP. It will be taxed under which one? AOP. Hope you got this point. It will be taxable not in the hands of the company, but in the hands of the promoter as what? AOP, Association of Persons. Everybody with me? Yes or no? Yes. Got it, guys? Okay. All revenue receipt is taxed unless it is exempt. This is 29. 29 talks about how will you compute. While computing, I will use Income Computation Disclosure Standards, ICDS. I will be using that also. That is what section 29 says. I will use Income Computation Disclosure Standards, ICDS. All the things will be taken into account. Right? Now, you see, same thing is there 29. Certain cases, embezzlement by a director or employee of the SEC during the course of business would be business loss, irrespective of the criminal prosecution launched against the person. So, if a director has stolen the money and gone, that money should have used for business, but now this fellow has stolen it. Since he has stolen it, it will be called as what? Business loss. Will it be allowed? Yes. I understand separate criminal proceedings might be happening to this guy, director, but still, will it be allowed as a business loss? Can you debit it to your P&L account? Answer is yes. Right? My Sugar Company Limited, any claim by the SEC trading advance as loss incurred in the course of business also shall be deductible. So if I've given some advance and that fellow has not given the service to me or is not provided the goods to me, that is a business loss. Correct? And this loss should be revenue in nature. This loss should not be capital in nature. So if I've paid a security deposit to run a cotton mill, that security deposit could not be recovered by the SEC. This security deposit was a loss which is capital in nature. I'm paying the security deposit to secure the building. Is it revenue in nature or capital in nature? Capital in nature. So that will not be allowed. But for supply of goods, I would have given some advance, no? It is revenue in nature. So I should see whether it is revenue in nature or capital in nature. Only revenue expenditure is allowed, capital expenditure is not allowed. Like that, there are cases. Case law names, no need to remember. There are a few which you have to remember, but predominantly no need to remember, guys. Okay. So 28 is charging section. 29 is how are you going to compute income, whether preliminary expenses are allowed or the only outside is allowed, I mean after later is allowed, is revenue expenditure allowed, capital expenditure allowed, that is 20, 30, which is 29, which gives the basics. 30 onwards, one by one, they start the expenses. 30, 31, 32 is depreciation, like that it goes on. That is what we need to do. Admissible deductions. So 30 to 37. 30 to 37 speaks about what? Business expenditure as a deduction. Right. So, section 30, expenses relating to building used for business or profession. Section 30 only talks about building. Section 30 only talks about building. Whereas if you see section 31 talks about plant, machinery and furniture. Section 30 talks about building. Section 30 talks about building. And section 31 talks about plant, machinery and furniture. Let's stick to building. Section 30, expenses relating to building. Owner, tenant. Guys, tell me one thing. I am the owner of the building. Can I pay rent to my own building? No. Even if I show it in the books, rent to my own building, obviously it is not deductible. Goes without saying. The rent owner giving rent to himself is not deductible. Owner paying rates and taxes deductible, no problem. Owner paying insurance deductible. Owner paying for all the revenue repairs deductible. Owner paying for capital repairs of the building. Is constructing an additional full floor. Will it be deductible expenditure? No, that will go as an asset. So it will not be debited to P&L account, but it will be an asset will be created on which you can claim depreciation. Capital repair means what? The entire building is gone, I'm fully renovating it. It's not a revenue repair. Full renovation is what? Capital repair. I'm rebuilding the entire stuff, so it cannot be called revenue repair. On the other hand, I am a tenant. I am a tenant. I'm a tenant, I'm paying rent to the building. Obviously, it is a deductible expenditure. Goes without saying, no doubt about it. Rates and taxes I'm paying, deductible. Insurance, deductible. Revenue repairs, deductible, obviously. And guys, capital repairs, obviously. When for owner only, if it is not allowed, how will it be allowed for tenant? Like tenant is telling the owner, sir, I have anyway taken the full building. I will make some capital repairs in this entire building, sir, because I need it. Anyway, you will not do it for me. I'll only do it. Will it be debited to P&L account? No, not possible. Right? But many tenants went to the finance ministry and they said, sir, there are many such buildings in India where I've taken it on 10-year rent, 15-year rent, 20-year rent, and I'm not going to leave the place. That is for sure. I don't want to leave the place. I will be here only forever. No problem. And I want an additional floor. I already have 4 floors. I have permission for the fifth floor. I want an additional floor. Who are you to tell me that I cannot have a fifth floor? I'll have a fifth floor. But it is actually like I'm only owning the building. I'm not the owner, I know. But actually, I'm the owner because I already have 4 floors, entire floor I'm only looking after. Fifth floor I'm constructing. I'll go to the owner and say, I'm going to construct this building, one more extra building. You don't have to pay anything, don't worry. If my tenure is over, I'll hand over the building to you. That's not a problem. But this entire 5 floors, I only want. So that fifth floor, if I'm constructing, I'll go to Nirmala madam and ask, madam, I've only constructed this, I paid 1 crore. You are telling me that I cannot debit it to P&L account. I totally understand. It's the principle. But madam, that 1 crore I have spent, at least allow me to claim depreciation. Deadly. At least allow me to claim depreciation. Deadly point. So I'm telling you, please allow me to claim depreciation. Weird. You are not even an owner. How can you claim depreciation on that? I said, no, I need it because I am the owner. Almost like the owner. I may not have the papers in my name, but everything I'm only looking after. Please give me this benefit. So, guys, is a deadly section, deemed ownership. Please read this point number D. Read ABCD, everything you read. ABCD you read. And let me know if you have doubts. That's the concept of deemed building. That's all. So, everything, all these things, expenses, any taxes that you pay, etc., everything has to be paid before the on or before the due date of filing the return of income. Then you see 31. Expenses relating to machinery, plant, furniture, etc. used for business or profession. Section 31. Owner paying rent, not deductible. Owner insurance, doing insurance, deductible. This is for what? Machinery, plant, furniture. Owner cannot give rent towards what? Machinery, plant, furniture because he owns it, obviously. Can owner pay insurance? Yes, deductible. Can owner, any revenue repairs can be taken care? Deductible. What about capital repairs? Definitely not deductible. Tenant, on the other hand, He pays rent deductible under section 37. Tenant providing insurance deductible. Revenue repairs deductible. Capital repairs by tenant not deductible. Which one? Yes, taxes paid by owner on behalf of tenant or on behalf of owner. Taxes paid by tenant on behalf of, yes, definitely deductible. You have to pay the rent in building, you have to pay the tax. I'm paying now. Definitely disallowed. It depends on the agreement. Some of the agreements say taxes shall be borne by the, most of the agreements say taxes will be borne by whom? Owner. But some of the agreements may say taxes should be paid by whom? Should be paid by tenant. So in that case, I'll say, boss, my expense is rent. The tax is not my expense, it's your expense. But still, if I'm paying on your behalf, please allow me deduction. Yes. So just like the deemed owner concept, there is no deemed machinery, deemed building concept. There is no deemed machinery, deemed plant, deemed furniture, etc. So here, nothing will be allowed here. So even if I buy a machinery on behalf of an owner, if it's in the owner's name, owner only will get depreciation. I will not get depreciation. So then it's like a loan. I'll have to give him a loan. He will buy the machine. I have to take back the loan. It's all capital in nature. There is nothing where I can claim any depreciation as such on an asset which is not owned by me. When I say asset, I'm talking about machinery, plant, furniture. It is only deemed building concept. It is not deemed machinery concept. So you should not get confused. And repair versus replacement, if it changes the entire efficiency of the vehicle, of the machinery, then it will become capital repair. Or if it is just I'm changing the oil or I'm changing parts of the engine due to normal wear and tear, etc., the machinery, plant and furniture, then it will become what? Very clearly, revenue repairs. It will become revenue repairs. Done. So this is regarding 31. So we finished 28, 29, 30, 31. Now let us dive into a very, very interesting concept of depreciation. Depreciation. Depreciation, sir, we have already studied this, sir. Yes, you have studied this, no problem. But what was the scene before? What is it now? Though you have studied in inter, little bit of revision is needed. Whatever I'm going to do now in the next 5-10 minutes may not be applicable for you in terms of what you say. I mean, they'll not ask the logic in CA final, CMA final, but you should know how it was before, what is it now, quickly, very quickly. These are some things which I've already studied in inter. But again, why is it there in final? Because they know that in inter you would have studied time pass. Some time pass you would have done. Here we have to do it properly. Okay. I am going to assume in all my classes that you guys don't know anything. In inter, you would have forgotten. When I say don't know anything, you would have forgotten everything. Am I right in my assumption? Either we have not studied tax properly in inter or we have forgotten everything. Yes or no? Only by a sudden stretch, I mean, by good luck, you may remember certain things. So I am going to assume we don't know anything. No problem. We are here to learn from scratch. Right? Yes. Point number B is for the owner. Owner, if he gives the capital repairs. Obviously, right? Machinery is going on. Machinery is there. I am the owner. Engine failed. I have to replace the engine. When I replace the engine fully, don't you think so? I should debit it. I should add it to my asset. Yes, the depreciation will be allowed. It is not for the tenant. It's only for the owner. Always for the owner. Here, Samya. 31 replacement cost. Here. Yes, as I told you, I explained this already. Repair versus replacement, it's very clear. Cost of replacement, whether it's revenue or capital, doesn't matter. What matters is whether it increases the productive capacity. I told you, I used another word, I said efficiency. If it increases the efficiency, productive capacity, then it will be a capital repair, which will be debited to P&L account, right? Sorry, it will be not debited to P&L account, it will be added to the asset. Or I need to see whether it will, even if it is a normal repair, whether it is going to impact the machine in a way that it may not increase the overall efficiency, but it is a current repair. The current repairs can either go under 31 or it can go to a general section called 37(1). So any revenue repair to the machinery, it is generic in nature. For example, there's just a group of machines, and along the machines there is a circuitry, electrical components, which will go to all the machines. Now, if I'm changing the electrical component, there is some wiring issue. It's a revenue repair. Now, where will it go? Is it a specific machine or in general? It's in general. So, classification, both will be debited only, no problem. But classification will go to which section? 37(1). 37(1) is general section. But if it's specific to one machine only, there are 100 machines, but only one machine has a problem. It will go to 31. That's all. Replacement concept. Correct? So if I am just repairing it, no problem. But let's say that machine is not working only because engine has failed. I have to replace the entire engine and to bring a new engine here. Without the engine, machine will not work. And engine is like replacement of the entire machine. For example, in a projector, you would have seen a projector, right? In a projector, that main component is there, which gives the lumens. That main, component of the projector. Other things are just hardware. But that component which produces that effect, if that only goes, replaced by one more thing, is it a capital repair or revenue repair? 100% capital repair. That will not be debited to P&L account. It will directly go as an asset. On the other hand, if the screen is broken, glass is broken, it can be replaced. That is a revenue repair. Hope you understood. Soumya? So no? Let me know. Did you get it? Okay. Come to this, guys. Depreciation. Come to depreciation. So depreciation. In the Companies Act of 1956, it was always a rate given. They had for different assets, different rates. 2013. In 2013 is based on the useful life. 1956 it is the rate. 2013 is useful. Sir, why are you telling Companies Act? Just for you to compare and study. That's all. Forget about Companies Act. Come to Income Tax Act. Income Tax Act till assessment year 87, 88, much before all of us were born. Assessment year 87, 88 means previous year 86, 87. I was also not born at that time. So 87, 88, what has happened? It was always called as the single asset method. Till that time, it was a single asset method. How does a single asset method work? This is the example. Example. Very simple. Year number one, I bought three buildings. Building A, building B, building C. Cost of building A 2 lakh, building B 2 lakh, building C 2 lakh. Right? Depreciation at 10%. 20,000, 20,000, 20,000. So what is WDV at the end of year 1? 2 lakh minus 20,000. 1 lakh 80, 1 lakh 80, 1 lakh 80. Then a single asset method. Year number 1, building A, building B, building C. Cost minus depreciation. WDV at the end of year 1 will be 1 lakh 80, 1 lakh 80, 1 lakh 80. There ends the matter. So building A, building B, and building C. Cost is 2 lakh, depreciation 20,000. Overall, WDV at the end of year 1 will be 1 lakh 80, 1 lakh 80, 1 lakh. Year number 2, in which building A is sold, assume. If the building A is sold in year number 2. So WDV at the year of the one end is how much? 1 lakh 80, right? Here. Only building A is sold. Building B, building C remains the same. Only building A is sold. One second, guys. Right. X1. So guys, as I told you, single asset method, building A 2 lakh minus 20, minus 20, minus 20, ABC were done. WDV at the end of year 1 was how much? 1 lakh 80, 1 lakh 80, 1 lakh 80 till year it's fine. Year number 2, building A was sold. How much it was sold for? Assume two scenarios. Scenario 1, it was sold for 1 lakh 44,000. Scenario 2, it was sold for 1 lakh 96,000. Scenario 1, it was sold for 1 lakh 44,000 only. Scenario 2, 1 lakh 96,000. It was sold for 1 lakh 44,000. First year you see. For asset number A, B, C. B and C, no change. B and C, 1 lakh 80 was at the end of first year, minus 18,000 second year, 1 lakh 62,000 will come for B, and for C, 1 lakh 80 minus 18,000, 1 lakh 62,000 will come for C. So for B and C, no change. For B and C, no change. But for A, there will be a loss of how much? 36,000. How is it 36,000? 1 lakh 80,000 asset, 1 lakh 80,000 asset is sold for 1 lakh 44,000. 1 lakh 80,000 asset is sold for 1 lakh 44,000. It will be how much? Loss of 36,000. And this loss of 36,000 is debited to P&L account. Right? Directly. Isn't this a loss? Single asset method. B and C are separate. A, there is a loss. How much there is a loss? 36,000. This 36,000 is directly debited to P&L account. And that is called what? Terminal depreciation. That concept is called terminal depreciation. Can you change that again ever? No, it's gone. So, because a 1 lakh 80,000 asset is being sold for 1 lakh 44, remaining 36,000 is a loss for me. I need to debit it somewhere. Where will I debit? To P&L account. What will I call it as? Terminal depreciation. This was in 87, 88. Sir, why are you telling all that? There's a reason. Because these two concepts are normal concepts which will come somewhere else. It will not come in depreciation because now it's not there. But we still have this concept of balancing charge somewhere else. We'll see that later. On the other hand, if it was sold for 1 lakh 96,000, if it was sold for 1 lakh 96,000, scenario number 2, sold for 1 lakh 96,000, then what will happen? See, B and C, no change, guys. 1 lakh 80, 1 lakh 80, 18, 18, 1 lakh, no change. The first asset, a 1 lakh 80,000 asset is sold for 1 lakh 96,000, 16,000 profit. So that year, they credited to P&L account 16,000. And that is called as a balancing charge. That is called as balancing charge. Got it? It is called as balancing charge. Understood this concept? If it is sold at a loss, entire loss was debited the same year, called terminal depreciation. If it is sold for a profit, entire profit was credited to P&L account as balancing charge. This was the single asset method. But in 88-89, they said, let us remove this stupid concept. Let us create a new concept called block of assets. If A, B, C are the same building, in the sense there may be residential building, there may be commercial building, same type of building. Let me club everything into one. Under Income Tax Act, there is no individual asset. There is always a block. Rather than making it 1 lakh 80, 1 lakh 80, 1 lakh 80, or here 2 lakh, 2 lakh, 2 lakh, let me make a block of 6 lakh. The moment an asset enters into the block, asset loses its individual significance, fully gone. The moment asset comes into a block, it loses its individual significance fully, gone, no change. 2 lakh, 2 lakh, 2 lakh clubbed together. At the end of the year, 1 lakh 80, 1 lakh 80, 1 lakh 80 clubbed together. Whatever depreciation has to go, it will go there. Whatever additions have to come, it will be added there. Simple. So, individual asset no longer there. It is a block. Additions will be made to the block. Deletions will be made from the block. Simple. So, if you see, they said, let me make a block of assets. Let me say opening WDV, actual cost of asset acquired during the year minus sale during the year. Sale can be normal sale. It could be assets destroyed. Because of asset destroyed, I may get some insurance compensation. Or if that particular asset is destroyed and there is no insurance compensation, I have to remove that component of the asset which was lying there. Which means if a 2 lakh worth of asset it got destroyed and I didn't get any compensation, then gone. I have to remove the asset. But if I got some compensation, it's like I got some money, so I have to subtract that money from there because I got some money back. Scrap value. I just removed it as scrap for 1000 rupees. The 1000 rupees will be subtracted. So opening WDV plus actual cost of assets acquired during the year minus sale. Assets destroyed, scrap value, insurance compensation subtracted will give me something called WDV at the end of the year. So opening WDV plus actual cost of assets acquired during the year minus sale will give me WDV at the end of the year. That I will subtract what? Depreciation as per Income Tax Act. When I subtract depreciation as per Income Tax Act, I will get the opening WDV for the next year. Opening WDV for the next year. What is that? So if you see, opening WDV nil, actual cost of assets acquired during the year 2 lakh plus 2 lakh plus 2 lakh, overall 6 lakh. minus sale of assets destroyed, scrap value is nil in my case. Why 2 lakh, 2 lakh, 2 lakh first year? Initially I didn't have any zero. How much I added that year? 2 lakh, 2 lakh, 2 lakh. Overall 6 lakh. Sale nil. Then here overall 6 lakh. WDV at the end of the year is how much? Overall on the block 10%, 60,000. Year 2, by the end of year 1, how much will I get, guys? 5,40,000. Then the entire block has become 5,40,000. That 5,40,000 is nothing but single asset method only if I add all these three. 1,80,000, 1,80,000, 1,80,000. Same thing. Now in year 2, same thing will happen, guys. Two scenarios. I'll either sell it at 1,44,000, I will sell it at 1,96,000. Same thing will happen. I will either sell it at 1,44,000 or I will sell it at 1,96,000. Same thing will happen. I'll sell it at 1,44,000 or 1,96,000. But I am not selling it individually. I'm selling it the block of asset I'm selling. I'm selling the block. In the block I'm selling. So if you see, an asset in the block is sold for 1,44,000. So opening WDV 5,40,000, there's no addition, subtract 1,44,000. So what will be the WDV? 3,96,000. Here it's sold for 1,96,000. What is the WDV? 3,44,000. So if you see the old method, if I do the old method, what is left here? 1,80,000, 1,80,000, 3,60,000. This is a loss, let it go. At the end of year 2, before depreciation, my whatever WDV before depreciation will be 1,80,000, 1,80,000, 3,60,000. This is a separate transaction. Here also 3,60,000, this is a separate transaction. But here you see, compared to the old method, here WDV has increased by 36,000. Here WDV has decreased by 16,000. Why? Why has there been a WDV increase of 60,000? Whatever I am removing here is less, no? 1,80,000 worth of asset, I am removing only 1,44,000. So 36,000 is remaining here. This is hiking up that WDV by 36,000. So the loss of 36,000 has increased the WDV by 36,000. Whereas here a 1,80,000 asset is being sold at 1,96,000, 16,000 more. In 16,000, the profit of 16,000 is decreasing the WDV by 16,000. The logic is simple. In the old method, that year only I would have debited 36,000 to the P&L account as terminal depreciation. That year only I would have credited 16,000 profit to the P&L account. But in this method, the loss of 36,000 has increased the WDV by 36,000. Which means in that year, am I debiting any 36,000? No. Because of the increased WDV, the depreciation also will be increasing every year. So that 36,000 will be set off over the next few years. 36,000 will be set off over next year. So in the single asset method, 36,000 that year only will be debited. In the block method, it will be debited over the next few years. Are you getting my point, guys? Yes or no? This is the concept of block assets. You already know it, but I'm just revising. Yes or no, guys? All of you? In single asset method, what is happening? That year only 36,000 debit. In block concept, what is happening? The 36,000 rupees is hidden here. Has increased the WDV by 36,000. And slowly over the years, it is getting depreciated. Whereas in single asset method, first year only 36,000 debit. Reverse. The profit of 16,000 directly credited to P&L account in case of single asset method. But in case of block method, because of 16,000 being removed from the WDV, the WDV is reduced by 16. Reduced by 16 means depreciation is also less by 16,000. At 16,000, less depreciation is spread across many years. That's the beautiful concept of block. That's a beautiful condition of block asset. That's the depreciation concept. Right? So this is all depreciation is all about. In the single asset method, it was terminal depreciation or balancing charge. Here it is the block concept. So any sale of asset at a loss will increase the WDV and thereby you will spread across the next few years. Any sale of asset as a profit will decrease the WDV and the profit will reduce the WDV and that reduced WDV will spread across many years. There are certain important conditions for WDV which we will do after the break. You guys take a break.